Hi, we're going to look at marginal costing, also called cost volume profit analysis, CVP. It's a cost and management accounting question. That's worth 80 out of 400 marks, or 20% of the Leaving Cert exam. We're just starting that section of the course now, and the first thing I suppose we have to remember is that financial accounting, which is what we've been doing up to now, that's primarily concerned with reporting on things that have happened in the past. It's backward looking, if you like, whereas this area of accounting, cost and management accounting, is forward looking. It's looking at what we think might happen in the future if we were to do this, that and the other thing. So applying that to Mango Limited, we can see that they're looking at what they think might happen in the next year. It's their budget for the coming year, where they think they'll bring in €960,000 from 80,000 units sold. And then they'll have costs of 473,000, giving them a net profit of 487,000. You'll notice that these costs are divided into what they're calling variable costs and fixed costs. And then they go on and ask you to make a number of calculations. Calculating selling price, variable cost per unit, and so on. Now, concentrating on the data in the box, we'll have a look at some of the principles that underline marginal costing. One is that your selling price is constant. You'll notice here that they expect to bring in €960,000 euro from 80,000 units. That means that they will have a constant selling price of €12 per unit. If you sell one, you're going to get €12. If you sell two, you'll get €24 in sales revenue. If you sell 100, you'll get €1,200 in sales revenue. A constant selling price. The second assumption is that you can divide your costs, you can separate your costs into two kinds, fixed and variable, as they've done here. Let's have a look at what those things mean. Fixed costs are the costs that don't change as we produce and sell more. So, for example, your rent, your rates, insurance and depreciation, they would be examples of costs that if you were to sell nothing that week, you'd still have to pay your rent and your rates and your insurance and your depreciation. They wouldn't change. They might be, for example, €1,000 a week or €1,000 a month, whether you were very busy and sold lots or whether you were very slack and sold very little. So a fixed cost would be a cost that doesn't change as you increase your output, doesn't reduce as you reduce your output or sales. And then the variable costs, the 400,000, variable costs are, as their name suggests, costs that will vary as you produce and sell more. If you increase your sales, they will increase, and if you reduce your sales, they will reduce. For example, direct materials and direct labour, that's the materials and labour that you use to produce your goods, they of course will increase as you become busier. They will decrease when you are slacker. So, to answer the question, part A, calculate the selling price per unit. Well, if you go through that there, you're getting a sales revenue of €960,000 from 80,000 units. That implies that it's a selling price of €12 per unit. Your variable costs are 400,000 over the same 80,000 units of sales. So that implies that they are €5 each. So every unit we sell will sell for €12, and out of that will come €5 for our variable costs, leaving what's called the contribution margin left over. Contribution margin is our selling price less variable cost. 12 less 5 gives €7. Every unit we sell at €12, well, the first €5 will be used up to cover our variable costs, and that will leave us with €7 remaining to contribute towards whatever comes next. Well, the first thing that comes next are your fixed costs. We've said that your fixed costs are €73,000. So the question becomes, how many units will you have to sell or produce, each contributing €7 to cover €73,000? You can see the calculation there of €73,000 over €7, giving us that awkward €10,428. 10,428.57 units. Now you can't sell 0.57 of a unit, so we always round it up. So that gives us 10,429 units of sales or production. And you're selling each of those at €12 each. So if the question asks you to calculate the break-even point in sales revenue, it will be 10,429 units at €12 each. Okay, so this question is telling us now that if we can sell 10,429 units, we will break even, meaning we will make neither a profit nor a loss. Part E asks us, what would our margin of safety be if we were to sell 30,000 units? Well, if we break even at 10,429 units, 30,000 units will send us 12,571 units beyond breaking even, and that's what our margin of safety is. Sales less break even, 30,000 less 10,429 would give us 19,571 units beyond what we need to break even, and each one of those 12,571 units sells at €12 each, so that would give us a sales revenue or a sales value of €234,852. Typically then the next part of the question asks us how much profit, how many units we would have to sell to make a profit of, in this case, €300,000. So the question is changing now. We don't just want to break even anymore. We don't just want to cover €73,000 in fixed costs, but we want to make 300,000 in profit. Remembering that each unit we sell at €12 gives us a contribution of €7. So the calculation becomes fixed cost plus desired profit, which is 73,000 plus 300,000, divided by the contribution margin of €7. And we'll make that profit from sales units of 53,283, each selling at €12. So we will make that amount of profit, €300,000 profit, from sales of €639,432. Typically the last part of the question asks us to explain, giving an example of what we mean by fixed costs. So coming back up here to our earlier explanation and example, fixed costs are those costs that do not change as output or sales are increased. For example, rent, rates, insurance and depreciation.